Hi, friends, it's Brad Brain. Wherever you are, I hope you are staying healthy and doing well. Like many of the stories I share, this one's from real life. And this isn't strictly about market timing in my story, but in the end, that's what happened. So, this particular fellow has been out of the markets for the last week, which has been a abysmal bit of bad luck because he missed a stellar week. The markets have been soaring this week. And this is what that means. Now, again, this is from the good folks at AGF. They put together this piece called Sound Choices Quick Reference Guide, and it's got all sorts of great visuals and concepts that are illustrated. I'm going to talk today about how market timing is a guessing game. My particular fellow, he didn't try to time the markets, but he got caught up by this exact same phenomenon. So here's the deal with this. I'm going to get a pen here so you can follow along here. So this is looking at what happened in the Toronto Stock Exchange over the last 20 years. If you put in $10,000 20 years ago, what would that have done for you? So, as it turned out, if you had just sat there and took in the good days and the bad days, had it all in stride, you would have made 6.25%. Now, if we take out just the top 10 days out of the last 20 years. Take 10 days out of 20 years. It cuts your return in half. You go from 6% down to 3. You go from $33,000 down to $18,000. How does that happen? Well, let me show you, because a couple pieces down from here, they have this one right here, and what this is looking at how those returns happen. Okay, so here's the scoop with this. The long-term results are actually pretty predictable, but they don't get there in a straight line. So this is looking at the gray is monthly returns and the purple is the 10-year rolling return. So what you can see here in these long gray bar pointing down, that is months where things go down a lot. Like this is the Great Recession, and we got 2 months back to back where things are down pretty close to 15%, right? Tech Rec here, if this one caught March of 20, it would be down here as well. So basically, we can have some pretty significant volatility in a short period of time, but we can also have some pretty significant upside here too, right? Here, this is one of the big rebounds coming out of the Great Recession, and the markets were up more than 10% or so in 1 month. Okay, so bottom line is if you take out some of these big days, it significantly impacts your long-term results. Now, if you just sit tight, the results are pretty predictable. We could look at anywhere from, I guess maybe that when there's one of the low spots, it'd be, I don't know, just for simplicity, I'll call it 5%. That looks about the high spot, 15%. So basically what it means is we got this nice tight band of results if we stay put, right? But if we take out even some of these good months, then we are looking at significantly impacting our long-term rate of return. So the bottom line is that market timing is really, really hard. It's very tempting, but it's really, really hard. Let me put it this way. Warren Buffett doesn't try it. So if Warren Buffett doesn't try it, probably you shouldn't try it either. So bottom line, to have the best potential to get the results you want, the strategy that's going to give you the highest chance of getting those results is you take a long-term approach, you stay fully invested, knowing that from time to time you're going to take a hit, but that's the price of admission. You got to be in the game to play it. And if you are going to take the bad days as a reward for being in there for the good days, you will get a chance to participate in the good returns that the markets can deliver for you. Okay, if there's any questions, if there's anything I can do for you, please let me know. I'm Brad Brain. Take care.